Thank you for sticking with us as we start peeling the layers of the onion. And now we are ready to do a deep dive into treasuries. So let's talk treasuries. Now, treasuries have various smaller canonical names, but we're going to take a very simple example yet again to truly understand what they are and, more importantly, why they even came into being. I'm going to give a very simple macroeconomic perspective. A treasury bill, or a debt instrument at the end of the day, is issued by an economy to borrow. The question then is, when do we need to borrow? If a country produces more than it consumes, it will have a surplus and therefore it doesn't need to borrow. If a country consumes more than it produces, it will have a deficit. That country needs to borrow. By buying treasuries, you are helping that government print money and administer and fund programs that are in the national interest and hopefully decrease the deficit in the long run. That, in the macroeconomic perspective, is why treasuries even exist. So, given that simple background, let's look at the kinds of treasury debt that are available to us as investors. Now, you can take a very simple instrument such as a T-bill. This is called a treasury bill because the term of that instrument is a year or less. There may be a 3-month T-bill, a 6-month T-bill, a 9-month T-bill, or a year T-bill. So anytime the duration is a year or less, that particular treasury instrument is called a treasury bill. And each one of those rectangular blocks indicates a coupon payment, so you know you're going to get 2 coupon payments during the term of that year. Now, what if the duration is more than a year? In that scenario, we call that a treasury note. So a note is something whose duration is more than a year and less than 10 years. And there are treasury instruments called bonds that may go up to 30 years. And so the point to really understand here is there are 3 kinds of debt: the bill, the note, and the bond. Now, the reality is if you go to a brokerage, you may find a T-bill that has a month and a half to go, 2 months to go, and you could still buy them because you are in a marketplace where someone else does not want to hold it anymore and you could buy them. I would humbly submit to you that if you are a prudent investor in fixed income, and if you kept your duration to a level that you are comfortable with, you should be able to hold these to maturity and not have to surrender money by trading before it matures. And we'll talk more about the costs of surrendering it before things mature and so on. All right, let's go to the next level of detail. There are a handful of additional types of treasury debt. We talked about the bill, the note, the bond. There is also another type called the FRN, or a flexible rate note. This pays differing coupons over the duration of the instrument. There is also the TIPS, something that is very popular today, where if there is inflation, it accommodates for the inflation, so you get an inflation protected return. And so there are many ways in which you can invest in a treasury. However, the question is, who do you buy from? You could go direct and buy directly from the United States government, or you could go through a brokerage. We're going to review how you can go direct and buy directly from the US government, the options available, the advantages, the disadvantages, and so on, and then go through a brokerage and review that as well. So let us go direct to the United States Treasury. Uncle Sam has a couple of major kinds of bonds: the I bond and the double E bonds. The fundamental construct is still the same. You give Uncle Sam a certain amount of dollars up front. Uncle Sam goes to work creating the tomato farm. In this case, the tomato farm may be roads, bridges, schools, you name it, any federally funded program that the government has to do. And while the government is doing its thing, if you were to buy direct from Uncle Sam, you get an astounding 9.62% interest that is calculated monthly, but it accrues annually. And we'll talk about what that means later. But you get an annualized return of 9.62% today, which is just unthinkable. And that cycle continues as long as you wait and you wait and you wait. At some point, maybe it's after a year, maybe it's after 10 years, you say, I'm done. The bond matures, or you say you are done, you want out. Your money will be paid back in full. You get the interest, but not all of it. You do forfeit the last 3 months of interest if you take that money out too early. If you let it sit there for more than a year, then you're good. If you withdraw the money within a year, you do forfeit a small amount of the interest. Nevertheless, at 9.62% annualized, this is an incredible deal for anybody today. At the end of that period, it may be a year, it may be 5 years, it may be 30 years, you get to make the decision of, do I want to put my money back to work and restart the entire cycle? Now, the interesting thing with direct buying from the Treasury is it beats every other investment vehicle today if your investment amount is somewhere between $25 and $10,000. So you could literally lend $25 to the United States government today. No management fees, no early withdrawal fees, none of that. If you park it there for a year, you will earn 9.62% a year. The other options for money between $25 and $10,000 pale in comparison. And even more exciting than all of this is that you get state and local tax free if you were to loan money to Uncle Sam. So my simple message to you, if you are looking to invest anywhere from $25 to $10,000, 9.62% is a phenomenal deal. You do your own investment decision. All I can tell you is that is one hell of a deal. Let's move past this to the next program. We talked about two kinds of bonds, the I bond and the EE bond. What is the difference? Well, the main difference is that the I bonds have a fixed interest that the government pays, and there is a little bit of an incremental kicker based on inflation, which explains why you're getting 9.62%. The EE bonds pretty much have a fixed interest. There are some very oddball exceptions of bonds issued before 1995 and all of that. We're going to skip that. But all I want you to remember is the I bond is fixed plus an incremental kicker, and the EE bonds have a fixed interest. Interest is earned monthly, but the compounding only happens at the end of the year. And you can decide at any point, hey, you know what? I don't want to do this anymore. I want my principal back. And as I mentioned earlier, you will lose 90 days of interest if you cash it before the maturity date, but at 9.62% a year, it still is one heck of a deal. Go I bonds in September 2022. One caveat, both of these bonds have a maximum of $10,000 per year per person. If you need more information about I bonds or EE bonds, you can go to treasurydirect.gov and you will be able to see information there. There are no fees, there are no commissions. You always buy the bond at face value. It's a pretty darn good safe bet if your investment amount is between 25 and 10,000. Now, having said that, that's a little bit too much moderation in my humble opinion, and you don't want to be John Smith. For those of you that are willing and daring to take a little more risk than that, come with me. Okay, now that we talked about buying direct from Uncle Sam, let's learn all about how to go through a brokerage. What are the top reasons you would even need a brokerage? Number one, a brokerage inherently is a market. There are some people buying, some people selling, and so you get more of an active marketplace. In Treasury Direct, you are the buyer and you have that security. You cannot sell it to anybody else. You can cash out, and that is about it. The next reason why you would want to go to a brokerage is that you're not limited by that $10,000. And so you can invest whatever amount you want to invest. And also, you don't just have to have treasuries, you can have stocks, you can have value stocks, you can have growth stocks, you can have preferred stocks, convertibles, and we'll talk about what any of those are and every one of those are as we go along. And one quick caveat, I'm putting some logos here just so you know what the available brokerages are. This show does not have any affiliation with any of them. Schwab and Ameritrade actually merged. Fidelity, E-Trade, Vanguard, Interactive Brokers, these are all large institutions. They may be the top 5 in terms of brokerages. I did do some research on Robinhood, and to the best of my knowledge, bonds are not supported in Robinhood. There may be an exception in specific cases, but my latest research as of this morning showed that you cannot buy bonds on Robinhood. Okay, then the question is, hey, there are all these wonderful advantages of going with the brokerage. Are there any gotchas? Like all things in life, yes. Brokerages have fees. That is how they make their money. You may think you're buying a bond for $100.40. The actual bond may be purchased by the brokerage for $100 and they tacked on that 40 cents, and you may or may not know. Or the brokerage may just say, for every $1,000, we are going to levy a fee of $10, so they can be very upfront and open about the fact that they have a certain kind of fee. And depending on the brokerage, they each have their versions of fees. One thing to note though, in general, when you buy treasuries through a brokerage, you do not pay fees or commissions. If you sell them in between, you will definitely have transaction costs in addition to potential face value loss if you were to sell it below the amount you bought it. So specific to treasuries, remember the brokerage gives you a variety of advantages, but there also are disadvantages. Having said that, if your investments are substantially more than $10,000 and you have multiple asset classes, you may probably have to pick the brokerage of your choice and go with it anyway. Okay, let's actually get to the act of buying a bond. And this is going to go through a lot of detail, so get your cup of coffee and we will be right back after this message from our sponsor. Wait a minute, that sponsor is me.